The stock market is not looking too good, and especially with everything going on, we have extreme fear in the market. A lot of people's portfolios are not performing as they wish. Now, of course, it's going to open up some buying opportunities, but a lot of people just don't have the cash. They were fully invested and they're seeing their portfolios tank. So what are you guys doing to survive this uncertainty in the market? We know that a lot of people around the country are not doing well financially, but stock markets were at all-time highs, mainly because of technology and artificial intelligence. So a lot of people are definitely over-leveraged in the market, but what are you guys doing to survive whatever is coming? So first of all, a lot of people are concerned about what's going to happen to SGOV, because interest rates fall means that the dividend yield for SGOV is going to fall as well. And we want to talk about SGOV a little bit. So we can see that it is pretty much used as a high yield savings. If you have your high yield savings in, say, Capital One, or you have certificate of deposits, or you even have money market funds, SGOV is a very simple way to place your emergency fund, put unnecessary cash that you don't need in the short term, but SGOV is going to give you that 4% dividend yield. Even with the rate cuts, it comes out to about 4.1%, which is a lot higher than a lot of these high yield savings accounts. And that's why SGOV has been one of the most popular places to park uninvested cash. It has $61 billion assets under management, and it has a relatively low expense ratio of 0.09%. Now, if we see interest rates fall even further, we're going to see the dividend yield of SGOV fall as well. And that is something to take into account. And what exactly is SGOV? Well, it's the iShares 0 to 3 month Treasury bond ETF. And you pretty much are not going to lose money with this ETF. So why SGOV? It's getting exposure to US Treasury bonds with remaining maturities less than or equal to 3 months. And it's going to be paying you dividends every single month. So it's pretty nice. Works just like a high yield savings or a money market fund. And if we take a look at the chart, you're pretty much not going to lose money. This is as safe as it gets with the short-term treasury ETFs. Now, we also want to talk about WEEK, which is Roundhill's competitor to SGOV. And it's the weekly T-bill ETF. It's going to invest in the same 0 to 3 month US Treasury bills, but the only difference is it's going to pay out weekly distributions to its shareholders. So that has been very appealing to a lot of investors. People want their income weekly, or even more often than that if it's possible, but the sooner the better for a lot of people. And we can see the distribution rate is about the same, about 4.1%. And it's going to be a cash-like alternative, giving you the exposure to the US Treasury bills with maturities between 0 to 3 months. Very attractive for a lot of people to preserve cash. And that is very key in an environment such as this, where there's a lot of uncertainty. And of course, you're going to have a stable NAV, this is as stable as you can get. It's going to target a stable NAV week over week. Now, one thing we do want to note is it has an expense ratio of 0.19%, which is a lot higher than SGOV, which was 0.09%. So this is 10% higher, which is a considerable amount. But we do see it does have already $141 million assets under management. And this is an actively managed ETF, very new as well, came out just this year. And if we take a look at the all-time chart for WEK, you're pretty much not going to lose money with this ETF as well. It's designed to stay above $100 per share. Now, if you're looking at the chart, it looks a little bit more stable. You're at the $100.05 price point. That's because when it's ready to pay out a dividend, it's going to run up the share price, and then once it pays out the dividend, it's going to drop back by that dividend amount. And that is why we're seeing fluctuations. Now, in the case of SGOV, because it's a higher dividend amount, because it's doing it every single month, we can see we're having a little bit bigger fluctuations. Even though it's not really that much, it's only a few cents, you are going to have a little bit of fluctuations. Now, you might be thinking, if you buy at the top, say $100.64, and then you sell after the dividend, which is about $140 40 cents, are you going to be losing money? The answer to that is no, because you're going to be receiving the dividend that was paid out. So it's going to offset any of that depreciation, but you really shouldn't be timing this. You don't really need to. And another thing we want to note is these ETFs are very tax efficient because they deal with Treasury bonds. You're not going to be paying any state taxes on the distributions, which is very nice. Now, comparing WEK to SGOV, these are very safe ETFs, very conservative, but we're going to be comparing these ETFs, the total return, which means you're reinvesting all the dividends. Let's see what the overall return is. With WEK, we're going to have 2.85% total return since inception, which was March of 2025, and SGOV, since that same time frame, is up 2.93%. Now, even though these are going to have pretty much similar dividend yields, it's going to be a difference in total return because WEK is a weekly paying ETF. There's a little bit more active management that the fund managers need to do to get it to be a weekly payer. In that case, the expense ratio is going to eat into your total return just a little bit. So if you're okay with that, if you want your distributions a little bit sooner, you are going to have to pay the price for it, but it's pretty negligible because it's only 0.07 or 8%, which is not much at all. Now, I've talked about this ETF a lot on the channel, which is TLT, the 20+ year Treasury bond ETF. So if you do believe that interest rates are going to fall quite dramatically over the next year or so, TLT could prove to be a solid investment because it is going to be a little bit more volatile than SGOV, where you actually can lose money with TLT because it has 20+ year long-term treasury bonds in the ETF. You're going to be getting a 4.3% dividend yield paid out monthly as usual, but you're going to have fluctuations in the share price. Now, how does interest rates affect TLT? Well, it's going to affect it because when interest rates rise, then this ETF drops. So we've seen during this high interest rate environment, TLT has absolutely plummeted. But when interest rates fall, that's when this ETF is going to rise in share price. And that's because these long-term treasury bonds that they are holding is now becoming more valuable. So that in turn is going to make TLT more attractive to a lot of investors as it maintains its similar dividend yield. And it's not going to affect the yield in the short term, which is why it changes in price. But I definitely want to know what your thoughts are on these treasury bond ETFs. It shouldn't make up your entire portfolio, as I mentioned earlier. It should be just using as a cash alternative, just earning a little bit more extra interest on your uninvested cash, or maybe just placing your emergency fund into these funds where it's going to grow a little bit more. TLT is basically going to be a play on the interest rates. If you believe that interest rates are going to fall, especially a considerable amount, this ETF could prove to have some good capital appreciation, all while paying you over a 4% dividend yield paid every single month, which is quite nice. And that's actually on par with SCHD, which pays a similar dividend yield, a little bit under 4%, which is also a very good ETF, in my opinion, in an environment such as this, where we're seeing extreme fear in the market. A lot of stocks and ETFs are dropping. So SCHD is now back on the table for a lot of investors. People are buying this ETF. A lot of people initially was not happy with the performance of SCHD once they saw the returns of ETFs such as the ones from YieldMax, ULTY, Pay, a lot of those ETFs, even MSTY. So a lot of people wanted that higher dividend yield compared to SCHD, which was only 3.8%. And that was the comparison people were making at that time. But SCHD, now back on the table, it's going to be a very solid ETF, very conservative. We take a look at the holdings, it's going to have a lot of companies that people need during recessions. We have gas, we have drinks such as Coca-Cola, we have telecommunications, UPS, a lot of necessities, which is why it's very stable during conditions such as this. And that's really when we're going to see SCHD outperform a lot of the overall market. We can see it's up 2.68% in the past week and up 2.25% in the past month. But I want to hear from you guys. What ETFs are you buying? Or are you just buying all your favorite income ETFs, your growth ETFs? You're not really caring if these ETFs drop in price significantly? Or are you utilizing options such as put options to hedge your portfolio? Or you're just kind of riding it out? Let me know down below what your strategy is. Or if you want any questions answered, definitely ask them in the comment section below.